Believe it or not, the IRS, they really and truly, they just want you to pay what you legally owe. They're not out there to get you to try to make you pay more than what you legally owe. They're not. So take every single tax deduction that you morally, legally, and ethically qualify for. The trick is you have to document it. That's what keeps you going the speed limit in this, is the documentation. So the IRS, that's the only way that they can judge it, is by how you document it.
Welcome to the Wealth Webinar Wednesday series. Today is September 21st. I'm Stephen Nagy, hosting for Chris Naugle, along with Shauna Decker will be here with us today. We have an awesome guest, Mr. Pat James, who is a tax expert. So I want to introduce you to Pat, but before I do so, I've had an opportunity to meet Pat in Buffalo. He was at our last 3-day Money School Essentials training and just knocked the socks off of it. Everybody was coming up to him after and wanting to talk with him and asking questions and having booking calls with him and getting a lot of help. So we said, listen, he helped so many people at our 3-day training. We asked him if he could please come back on and be a guest for the Wealth Webinar series, where, as you guys know, we get a much broader reach. So you guys are in for a treat today. Pat is an awesome guy. He's out in you're out in Seattle, right, Pat? You're usually on a boat, but you were saying you're not on your boat right now, right?
No, we're going to be heading out there actually the day after tomorrow. So, I live in a little town about 40 miles from Seattle called Gig Harbor. It's a little kind of fishing community on the water, and it's nice and laid back the way we like it.
Absolutely. I hear you there. Well, so on the topic of Pat, let me just give you guys a quick introduction. I'm going to turn it over to him, so we got no time to waste. He's got a lot to talk to you about. Taxes. Everybody knows the tax code book is this big, and we got to learn how to save on taxes. And what we talk a lot about in Money School are the 3 wealth killers. We talk about inflation, volatility, and taxes. And these are all things that we can learn and we can all do, take advantage of laws that are in place in this country that are completely legal. We just need to learn how to do it the right way. Somebody once told me, one of my tax mentors, there's 2 tax laws in this country, one for the informed and one for the uninformed. Both are legal. So which one are you following? And that's what Pat's going to talk to you guys about today. So Pat is a former 6th grade school teacher, started investing in 1998 with $1,500 and made around $250,000 that year. He had a CPA help him with his taxes, and he paid only $62,000 in taxes. He then met former senior trial attorney for the IRS, who showed him how to document his expenses to capture all deductions he was allowed. And in 1999, he made about $250,000 again, but that year only paid $3,500 in taxes. So from $62,000 doing it the way everybody else does it to $3,500 doing it the way the professionals do it. You can choose which one you'd rather pay and which money you'd rather save. So it's all about capturing the deductions. And that's exactly what Pat's going to talk to you and show you here today how to do. So the more deductions you can take, the more you're going to save on your taxes. So Pat, please take it away.
All right. That sounds great. Let me hit my share screen button here. My name is Pat James. I'd like to welcome everybody. And here's what we're going to do. This is going to be very, very, very informative to everybody. Number one, I'm not going to talk about how to fill out tax forms and tax code and all that kind of stuff. What I'm going to show everybody is how to document your expenses and what kind of tax deductions are available to you. I'm going to show you copies of my tax returns, but to get started, I want to tell you a little bit, take about 5 minutes and give you a little bit about my background, who I am, who I'm not, and how this whole thing kind of started. I used to be a 6th grade school teacher, and back in the late 90s, it was actually 1998, I guess. I was making about $1,500 a month as a school teacher, teaching 6th grade. And I was sick and tired of being broke. And I thought, the way to get out of this rut was real estate. So I went and I found a house that I wanted to buy. And I was a rental property. I was going to get into the rental property thing. So I bought this house and I got a tenant. And my tenant, his name was Earl Brightson. Earl just happened to work for a seminar company that did seminars on the stock market. And I had no interest in the stock market whatsoever. Didn't even know if Dow Jones was a real person or not. So Earl kept bugging me and bugging me and bugging me to come to one of these seminars, this company he worked at. And so finally I told him, I'll go to the seminar if you quit bugging me. And so I went. It was a Friday night. And when I went to this seminar, within the first 10 minutes, the speaker that was up there said, you can buy a stock at $10 a share and it could go to 12 or it could go to 8. And you can make a profit either way, no matter which way it moves. And I thought, what in the world? That made no sense to me. But it's true. If you know what you're doing, you can make money. If the stock market goes up, you can make money if it goes down, depending on what your strategies are. So anyway, make a long story short, I went ahead and I purchased their program and I started following exactly everything that they said. And I started out with $1,500. I opened up a brokerage account, like they said. And by the end of 1998, folks, I had turned that $1,500 into $250,000. And so now all of a sudden, I went from having an income problem to having a tax problem, right? And I had no clue about quarterly estimated taxes or how to document things. I knew nothing. I was a 6th grade school teacher that always had an income problem, never had a tax problem. So that's what happened. I was talking with a really, really good friend of mine. His name is Stan Barker. He's been a mentor to me. He's owned several businesses. He's made millions and millions of dollars in business over here in Washington State and stuff. And I was talking with him and said, I'm not exactly sure what to do or how to do it. And he said, well, let me give you the name and phone number of somebody, a guy by the name of Scott Estel, who just happens to be the former senior trial attorney for the IRS. And I said, okay. So he gave me Scott's name and phone number. Well, I didn't do anything right away on that. What I did do is I went to my mom and dad's CPA, and his name's Joe Doria. So I went to Joe Doria's office and he said, Pat, here's what we're going to do. Now it's April 11th, 1999. The taxes are due April 15th, by the way. But April 11th, 1999, I talked to Joe Doria, went into his office, and he told me we're going to file an extension. It's going to give me time to get all my ducks in a row and all this kind of stuff. And I had done a real estate deal. I made a bunch of money in the stock market. I had all this stuff going on. So he said, we're going to file an extension. I get up to leave his office and he says, oh, Pat, before you leave, I need you to get out your checkbook. I said, no problem. How much do I owe you, Joe? And he said, no, you don't know. We're going to send you a bill monthly. But I need you to do is get out your checkbook because you need to write a check to the IRS. And I said, well, you just told me we're filing an extension. He said, that's to do the paperwork. You still have to pay the IRS by April 15th. And it's April 11th right now. So get out your checkbook. And I said, well, how much do I owe? And he said, well, on your personal taxes, because you paid yourself, you have a Nevada corporation set up and you made $250,000 in your corporation. You paid yourself $80,000. And so you owe about $20,000 in tax on your personal tax return. I said, $20,000? That's more than I used to make working full time as a school teacher. He said, yep, $20,000. So I wrote a check for $20,000 payable to the IRS, and as I'm wiping the tear from my eye, he said, now I need you to write a check for $42,000 for your business tax return. That was a $62,000 day for me. That was crazy. So that changed everything in my life. And so that's when I called Stan Barker and said, Stan, I need your help. Can we get together? He said, sure, meet me at Starbucks. I met him at Starbucks. He gave me Scott's phone number. I called Scott on the phone. It's still April 11th. It was a long day. So I called Scott on the phone, and lo and behold, Scott actually answered the phone. I thought I was going to get a receptionist or something. Scott answered the phone. So I spent an hour on the phone with Scott explaining all of this to him. And he said, Pat, you have way overpaid your taxes. I said, I knew it. Joe Doria did it wrong. He said, no, Joe Doria is doing a perfect job. It's all computer automated anyway, Pat. He said, all you do is you take the information, you plug it into the computer, and it spits out your tax return. And Joe Doria, he's not going to mess up on that, okay? He said, the problem is you gave Joe Doria all the wrong information because nobody ever taught you what information to give your tax preparer. And if you want to save money on your taxes, you need to categorize your expenses and give your tax preparer the correct information. I said, I didn't know that. I said, well, can you help me? He said, yeah, I can help you. And I said, well, how much do you charge? Right? That's the obvious next question. And he said, Pat, I'm the #1 tax attorney in the country, and I'm going to charge you a $4,000 retainer. And then I charge $400 an hour. And I said, no, thanks. I said, Mr. Estel, I said, is there any way that you could just give me a flat rate? I said, I don't know if you're talking about 5 hours or 500 hours, and I can't pay $400 an hour with no limit or anything. And he said, well, you're a good friend of Stan Barker's, right? I said, yeah, Stan gave me your phone number. That's how I got in touch with you. He said, I'll tell you what I'll do. How about if I just charge you my $4,000 retainer, and I'll help you out, and I won't charge you anything hourly? And I said, that would be awesome. That would be great. One more question for you though. Can you save me more than $4,000? Because I don't want to pay you $4,000 if you're only going to save me $1,000. He said, Pat, based off of what you told me over the last hour, I can save you tens of thousands of dollars. I said, tens like plural? He said, yeah. I said, so let me get this right. I pay you $4,000, you save me $20,000. He said, that's correct. So I hired him. And I'm going to show you exactly what he showed me. And I'm going to show you the deductions that we've taken. I'm going to show you my tax returns. I'm going to show you all that. I'm going to teach you how to, you can save literally tens of thousands on your taxes, okay? Asset protection versus taxes. People say all the time that these are kind of the same thing, and they're not even close. Asset protection protects you from other people, like lawsuits and things like that. Taxes are between you and the government. What we're going to talk about today is taxes, how to save more money from what you pay to the government in taxes. So here's my 1998 tax return, okay? This is the one I had Joe Doria do. This is my personal. I'll show you the business one in a second. So on my personal tax return, I paid myself $82,538. Now remember, prior to this, I was a school teacher making $1,500 a month. So this is a big jump for me. So $82,538. And then remember Joe Doria said I needed to write a check for $20,000. I wrote a check, paid in $20,000. Lo and behold, about, I don't know, a month or two later, I ended up getting a check back for $5,000. I actually got a refund. I'm into the IRS about $15,000 on my personal tax return. And eventually, 2.5 years later, the IRS refunded my entire $15,000. That's the last thing I'm going to show you guys today. I'm going to show you how you can go back over the last 3 years of tax returns that you have filed, and any money that you accidentally overpaid, by the way, that's called a donation, right? So any money that you accidentally overpaid because you didn't take all the deductions you were legally entitled to, the IRS is required by law to refund that money to you. So I got my entire $15,000 back. And so I'm going to show you guys how to do that also. So here's my good friend, Stan Barker. Sometimes it's not what you know, but who you know that makes a difference. He's the one that put me in touch with Scott Estel. And so here's my 1999 tax return. On my 1999 tax return, this shows $79,500 that I paid myself, okay? And of that $79,750, now this is when I met Scott. Scott showed me how to categorize my expenses the right way. Taxes due, $19. Remember, the previous year, I had my CPA do my tax return, and I paid in $20,000. This year, I paid in $19 to taxes. So here's how it works. I don't know if you guys can see this or not. So here's your income, here's your tax deductions. Subtract your tax deductions from your income, and whatever's left over, that's what you pay tax on. So what Scott taught me is how to take my tax deductions from here up to here. Now you subtract your tax deductions from your income and you only pay tax on what's left over. So that's really the name of the game here. You only pay tax on what's left over. So how are we going to increase our tax deductions? That's what I'm going to show you. Let me show you a couple more tax returns here real quick, and then we'll get into it. So here's my 2008 tax return. 2008, I paid myself about $100,000. I don't want to pay myself more than that personally. We made a lot more than that, but we made it in different entities and LLCs and stuff like that. But personally, I don't want to make more than about $100,000 because there's something called the AMT that kicks in, and the AMT is called alternative minimum tax. And if you make more than about $100,000, they actually start taking away your tax deductions. So even if you have the tax deductions, they start taking them away. You don't get to claim them. So you don't want to make more than about $100,000 personally. That's why we set up LLCs and stuff like that. Because you make more than that much money, they start taking away your tax deductions. $101,000 of income. Do you really think I have $101,000 of tax deductions? No, not on my personal. I had a lot because I was able to categorize things the right way. I have 4 children, stuff like that. So taxable income, I was able to get my taxable income down to about $9,300. So here's my tax deductions. Here's my income. Subtract my tax deductions from my income, and I got it down to where my taxable income is just a little over $9,300. Tax due was going to be $938. That's what I owe in tax. However, because I had 4 kids, I was entitled to what's called a tax credit. And tax credits are different than tax deductions. Tax credits, you get to subtract dollar for dollar off of what you owe in taxes. And I had up to a $1,000 tax credit. So I can subtract up to $1,000 off of what I owe in taxes. I owe $938 in taxes. I'm going to take $938 of that tax credit and I get to subtract it. Federal income tax due, 0. And that's off of about $100,000 worth of income, folks. Okay. So let me show you a couple business returns here real quick. I set up a Nevada corporation, and I was advised by my attorneys to do that. So it was called PJ Financial. Why PJ? It's my initials, Patrick James, right? Pretty creative. So PJ Financial, a Nevada corporation. And in 1999, this is the year I met Scott, I made just under $250,000. And because I was able to capture all these tax deductions, you subtract your tax deductions from your income, I was able to get my taxes down to $3,500 on almost $250,000 of income. That was 1999. Here's 2008. 2008, I made just under $1 million, about $900,000. Taxes due, $1,700 on just under $1 million of income. Why? Because of the tax deductions. Here's 2011. Apparently we were in a recession. I didn't get the memo, I don't think. So I'm at almost 1.2 million. Taxes due, 0. How and why? How can a person make $1.186 million and pay 0 in taxes? Well, this year, Congress passed a law that said, because they're trying to stimulate the economy and everything, they passed a law that basically said, we're going to give people bonus depreciation. I was going to owe about $300,000 this year in taxes. I just made too much money. And I was on one of these conference calls with Scott. This was, I think, in either September or October 2011. And he was talking about bonus depreciation and how you can buy something for your business and you can write off the entire amount this year. It doesn't have to be depreciated out and stuff. And so I thought, man, I'm going to owe about $300,000 in taxes. I need to go buy something to get a tax deduction and 0 my taxes out. So it was all about tax planning is what it was. So taxes really and truly, folks, are 365 days a year. Taxes are not April 15th. That's tax preparation, okay? Tax planning is 365 days a year. So here's what Scott says. He says, I teach people how to document their expenses, capture every tax deduction they're legally allowed, and how to become audit proof in the process. Your tax preparer can only be as good as the information that you give them. So this is all about tax planning and how to categorize your expenses the right way to learn how to do this. So here's what you need to know in order to lower your taxes. This is what's going on here. There's three things. It's like a three-legged stool. And if you take one of the legs away, the stool's going to fall over. So number one, knowing what the tax deductions are. This is what you need to know. This is not your tax preparer or your accountant or CPA or anything else. This is you. You need to know what the tax deductions are. If you don't know what they are, how are you going to implement those strategies into your life, right? The second thing you need to know, once you know what the tax deductions are, is you need to know the rules around them. You need to know what you need to do to implement those strategies. So it's one thing to know, hey, you can write off miles on your car, which you can. But now you need to know how to implement it. They have to be business-related miles. Do you need to write down your beginning and ending odometer statement reading? How often do you have to do that? You know, and do the miles start from your house or do they start from your first place of business? And how do you document it exactly so you can capture these deductions in case you're audited? What kind of proof do you need? So knowing how to implement them. And then number three is knowing how to document everything. And this is huge. If you don't know how to document your tax deductions the right way, the IRS is absolutely going to disallow them. In fact, if you have a tax preparer, somebody preparing your taxes, a tax professional, if you don't have them documented the right way, they probably won't even allow you to take the tax deduction. So knowing what the tax deductions are, knowing how to implement them, and knowing how to document them. That's what I'm going to teach you. There's over 72,000 pages of tax code and supporting documents. 72,000 pages. There are so many tax deductions available to us people. You just need to know these three things. So here we go. I started following Scott's system in 1999. I'm going to call a 60-second timeout and I'm going to do the Scott commercial, okay? Most of you on this call, you're going to want to use Scott's system on a go forward basis for the next, however many years of your life you have left paying taxes. And this is something that will stick with you forever. So this is what I did. And this is how I started following Scott's tax system. Remember, I was on the phone to him and he said he was going to charge me $4,000 and he would help me. So I paid him the $4,000. I gave him a credit card over the phone and he sent me a big box of a whole bunch of stuff. There were a bunch of cassette tapes in there. There were like these 3-ring binders with these photocopied pages and just all kinds of stuff, right? And so he told me, he said, Pat, I want you to go through this stuff, but only go through what pertains to you. So if you're not looking at buying a new car right now, don't look at the new car section. Don't do that. There's too much information. So just go through the things that apply to you right now and start documenting them and learn this stuff. And then by the end of the year, you'll have everything documented. I'm going to show you how to document it. You'll have everything documented the right way. And so then at the end of the year, when it comes time to do your taxes, it'll take you maybe 30 minutes to prepare everything. And you'll be able to capture every tax deduction you're legally allowed, and you're going to become audit proof in the process. And I said, sounds good to me. So this is what Scott's program is, folks. He has a manual. No longer is it a 3-ring binder with photocopy pages or any of that kind of stuff. This is a really nice manual. There's over 320 pages of different tax strategies and different things you can do to save you money on your taxes. And it's not basic plain Jane stuff. This is a lot of, you take this tax deduction and take this tax deduction and we put them together and poof, we come up with a new tax write-off. I'm going to show you a whole bunch of the stuff that's in here. So 320 pages. This tells you what the tax deductions are. It references the tax code, and it is so simple a sixth grader could actually follow this. It's a nice big bold print, and he has all kinds of different tax tips in there and all these tax deductions, and he makes it so he has taken 72,000 pages of tax code, boiled it down to 320 pages of tax deductions, and makes it so simple. Like I said, a sixth grader could read it. So he also put together a bunch of videos. These videos go along with the manual. So each video is one chapter in the manual, is what it is. And the videos teach you how to implement the strategies. So the manual tells you what the strategies are. The manual shows you what the tax deductions are. The videos show you how to implement them into your life. Now, a lot of people don't even have DVD players anymore. I know the computer that I'm on right now doing this webinar, I don't even have a DVD player in this. A lot of people have tablets, they don't have DVD players. So what he did is he also put all of these videos on a USB stick. So you're going to get all the DVDs, you're going to get the USB stick. Also, this is really cool. All of the videos are online. So you're going to get digital access to all the videos. So you're going to get a user ID and a password, and you can go in and you can watch these anytime you want, and because they're online. Here's the beauty of this. On a go forward basis, whenever there's major changes to the tax code, Scott goes in and he updates the videos. So as the tax code changes, you are always going to be up to date. You don't have to go in and repurchase anything. This is a one-time shot, and you're going to be up to date all the time from here on out because everything gets updated in here. There's also something called the tax tracker. Scott put this together in the exact same format that the IRS agents are required to use. So if you get audited, you're going to go into the audit with a day planner, basically, or tax tracker that's in the exact same format that the IRS agents are required to use. So that's pretty cool. Scott's complete tax planning and strategy system, it's $3,995. When I bought this back in 1999, you guys, I paid $4,000 for it. So it's $3,995. It's tax deductible. If you want to order it, you go to the website mytaxkit.com and you can order it anytime you want. What he's doing, because of this webinar and because of Chris and the group out there, the first 20 people who order this at mytaxkit.com, he's going to give them a 50% discount. So if you're one of the first 20 people, when you go to mytaxkit.com, it'll tell you if you're one of the first 20 people or not. And you'll be able to get this at a 50% discount. So it's $1,997. Also, there's a 30-day, 100% money-back guarantee. So if you order it, you don't like it for whatever reason, you return it and they refund your money right back on your credit card before your credit card bill even comes due. So it doesn't cost you a dime to take a look at this and to check it out. There's free shipping, 30-day, 100% money back guarantee, mytaxkit.com. You can order it whenever you want. So that's my Scott commercial. There's also a free bonus that you're getting. So Kevin O'Leary from Shark Tank, he's Mr. Wonderful. He is actual part owner in a tax firm, and they do some incredible stuff. They do tax returns for people, but they also help people identify different tax deductions they're entitled to. So they don't teach you how to implement the tax deductions or how to document them. They don't teach that, but they'll look at your overall situation and they will tell you, you qualify for this deduction, this deduction, this deduction, this deduction. They have a $10,000 guarantee, and anybody who gets Scott's program, you're going to get this as a free bonus. They guarantee that they will find you $10,000 in missing or potential tax deductions for your business, or they'll give you $100 just for your time. Okay. So that's just a free bonus. I got $17,231. So there's a copy of my check there that I got. So that's a free bonus that you get for anybody who gets Scott's tax program. Kevin O'Leary's tax firm will go ahead and go in and do this review type thing for you. So what you're going to learn with Scott's help is what the tax deductions are, how to implement them, and how to document them, and you become audit proof in the process. So that's what that is. So here we go. The national average for every dollar that you do not deduct, you're going to send an additional 30 cents on the dollar to the government. Now, there's not even a 30% tax bracket. This is just what the national average is for people with their taxes. And depending on what state you live in, it could be a little bit more, it could be a little bit less, because some states have state income taxes, some don't, whatever. So like if you live in California, you're above average. It's going to be a little bit more than this. So it's 30 cents on the dollar. And a lot of people say, Pat, I don't do that. I don't give 30 cents to the government every time I spend a dollar. Yes, you do. Absolutely. If you don't believe me, go look at your pay stub. Look at how much money you made, and then look how much money you get to deposit in your bank account. Because several years ago, I don't know when it was, probably 60 or 70 years ago, the government got smart, they thought, and they decided, hey, we're going to make the employers in America the largest tax collection agency in the world. And we're going to require the employers collect all the tax dollars before they give their employees their paycheck. So the employers are the largest tax collection agency in the world, and they're required by law to hold back your tax dollars, pay it to the government before you even get your paycheck. How do you like that? So it is 30 cents on the dollar, folks. And if you're paying your own taxes, if you're paying quarterly estimated taxes, you know exactly what I'm talking about here. So it's 30 cents on the dollar. So what that means, if you go to Starbucks, let's say that Shauna and I haven't seen each other in a long time, okay, a couple of years. And I fly out to Buffalo and I see Shauna and say, Shauna, so good to see you. I haven't seen you in a few years. How's the family doing? Hey, let's go to Starbucks and I'd love to buy you a cup of coffee. So we go to Starbucks and Shauna, she orders a double grande caramel macchiato with extra whipped cream. And I'm thinking, wow, that looks pretty good. So I order one also. Next thing you know, I'm into Starbucks about $10, right? Well, not really, because it's actually $13. I have to spend $10 to Starbucks. And because that is not tax deductible, there is no tax deduction for me and Shauna to go to Starbucks to catch up on old times. That is a non-tax deductible event. So I spend $10 at Starbucks, and because I don't get the tax write-off, now I have to send $3 to the government. But I don't really send $3 to the government. That's kind of silly. What it is, it's either on a quarterly basis for quarterly estimated taxes that I have to send just a lump sum, all right? Or if I'm a W-2 wage earner, it's automatically taken out of my paycheck. So that's how it's done. So how do we make this tax deductible? That's the question of the day. And everybody all across America says, Pat, if you talk about business, it makes it tax deductible. That is 100% not true, folks. That is not true. Everybody in America thinks the exact same thing. If you talk about business, it makes it tax deductible. There is nothing in the tax code that says that. Absolutely nothing. Here's what it says in the tax code. It says, if your intent is to talk about business. See, it's all about intent. Why did you go to Starbucks in the first place? And our intent in going to Starbucks was to catch up on old times, because I haven't seen Shauna in a couple of years, right? That is not tax deductible. No matter what we talk about at Starbucks is not going to make that a different intent. Our intent was to catch up on old times. Understanding this is what I'm going to tell Shauna. Shauna, so good to see you. I haven't seen you in several years. How's everything going? Hey, how about if we go to Starbucks and I buy you a cup of coffee? I got this crazy real estate thing I want to talk to you about. My intent is to talk to her about a real estate investment. And regardless of whether we talk about that or not, regardless of if she's interested in that or not, it doesn't make any difference. Now Starbucks becomes tax deductible to me. And we could walk into Starbucks and Shauna could say, Pat, I don't want to talk about real estate, but let's catch up on old times. Guess what? It is still tax deductible because my intent was to talk about business. My intent was to make a profit. So here's what it says in the tax code, folks. This is in Scott's manual, by the way. It says, if your intent is to make a profit, any meals within 24 hours of a business discussion, and going to Starbucks for a cup of coffee, that's considered meals, basically. Okay, it could be beverages, it could be going out to happy hour, it could be doing whatever you want to do, you know? So any meals within 24 hours of a business discussion can be tax deductible as long as at least one of the people from the business discussion, other than yourself, is at the meal or at Starbucks or whatever with you. And it could be 24 hours before or 24 hours after the business discussion. That's a 48-hour window right there. So think about this. You can go back over the last 4 years of your life, and any tax deductions that you did not take, you are allowed to go in and reclaim those tax deductions. And the IRS is required by law to refund your money to you on tax deductions that you didn't take because you didn't know about them. You can go back in and reclaim those tax deductions. It's on a form called a 1040X. I'm going to show that to you in just a little bit coming up here. As we go through this, think about the last 4 years of your life and if you missed any of these, because if so, you're entitled to get a big check back from the IRS, and they're required to pay you interest on your money also. So if you have a business intent, Starbucks can now become a tax deduction. And the way you track all this is in your tax tracker. I'm going to show you that also. According to the IRS, what you need to do in order to qualify for hundreds, if not thousands, of tax deductions is you need to have the intent to make a profit. So everything that I do in my life, pretty much, I go places, I talk to people, whatever it is, I'm going to be talking to them about entrepreneurial type things. I'm going to be talking to them about the intent to make a profit. If you purchased a new or used vehicle within the past 4 years, okay, so any of you out there that have purchased a new car or used car or leased a car within the past 4 years, and the GVWR, the weight of the vehicle, is over 6,000 pounds, you can actually be entitled to a $25,000 tax deduction. See, these are things that most CPAs and accountants, they don't tell you about. So $25,000 tax deduction, that's about $8,000 in your pocket. So if you get a $25,000 tax deduction, you get to subtract that from your income, and now you just lowered your taxable income. That saves you about $8,000 cash in your pocket that you now don't have to pay in taxes. So what's the GVWR? That's the weight of the vehicle. So when we're done with this webinar, go out to your car, open up the driver's side door. There's a little white sticker on the door jamb there. It tells you what PSI to inflate your tires to and all that. There's also a GVWR number. And if that's over 6,000 pounds, guess what? You can be entitled to a $25,000 tax deduction. All right. So what kind of cars qualify? Cadillac Escalades, Ford Excursions, Hummers, the new 4-door big luxury new trucks, Lincoln Navigator. These are all gas guzzlers, by the way. So why would Congress pass a law? By the way, Congress passes all the tax laws, not the IRS. The IRS, they're just out there with the radar gun, making sure you're following the laws, just like the state patrol, saying you're following the speed limit, right? Congress passes the laws. Will Congress ever pass a law that hurts themselves? No. So Congress passes these laws. So why would Congress pass a law that says if you drive a gas guzzler, you can be entitled to a $25,000 tax deduction? That's crazy, because what do you think they drive, right? Yeah, they'll never pass a law that hurts themselves. So I bought a new vehicle. I use this 100% for business and for my rental properties, and we do a little property development stuff out here. And we've been actually buying a lot of raw land and putting manufactured homes on them and then flipping them and stuff. So this is it's my work truck, and it cost me $72,000. So how did I get a $72,000 tax deduction if they only allow $25,000? Because this year in 2022, folks, Congress passed a law that's called bonus depreciation. And bonus depreciation says if you buy anything for your business that normally would be depreciated out over several years, you can take that total tax deduction this year. So I went out and I purchased a $72,000 Ram 2500, 3/4 ton 4-wheel drive pickup truck because I needed a new work truck. Guess what? I just got a $72,000 tax deduction. Now check this one out. All right. Let's say that somebody was able, here's their income, here's their tax deductions. Subtract your tax deductions from your income. Let's say that you're able to get your taxable income down to $72,000. That's your taxable income, $72,000. And let's say that you need a new work truck like me. And so you go out there and you borrow the money from the bank or the credit union or GMC Financial or wherever. You borrow the money and you buy a truck. Number one, you never pay tax on borrowed money. Borrowed money is tax-free, okay? Number two, if you paid $72,000 like I did on this, even if you borrowed the money, you now can qualify for a $72,000 tax deduction. So you had $72,000 worth of taxable income. You now get a $72,000 tax deduction. Subtract your tax deduction from your income. Now your taxable income is zero. Taxes due, zero. This is all about tax planning, folks. It's all about learning how to plan and how to categorize your expenses 365 days a year, not just April 15th. April 15th, that's the day that the paperwork's done. But 365 days a year is when you document your expenses. So you're going to capture all the deductions on April 15th. How about this one? Any dry cleaning or laundry that is done while you were in travel status is 100% deductible. If you do it when you're at home, there's no tax write-off. So any dry cleaning or laundry that's done while you're at home, you don't get any tax write-off. But if you're not spending the night at home and you get your dry cleaning or laundry done, this is a crazy one. Why would Congress pass a law that says, take your dirty clothes with you when you travel and have your laundry and dry cleaning done and we'll give you 100% tax write-off? That makes no sense to me. But apparently Congress doesn't want to go home with dirty clothes, I guess. I don't know. But okay, that's in the tax code. That's somewhere in that 72,000 pages. All of this is in Scott's manual, by the way. You can rent your house for up to 14 days per year and you don't have to report the income. So I can rent my house, my condominium, my apartment, my whatever it is, my motorhome. I can rent it for up to 14 days per year, and I don't have to report the money that I get from that as income. It's tax-free money. We're going to talk more about that in a minute. This is a little golf course over in University Place, Washington, really close to where I live. We live down here on the water in a little town called Gig Harbor. This is a golf course that they had the US Open a few years ago, and it's called Chambers Bay. I called Scott on the phone. Scott lives in Colorado. And I said, hey, Scott, can you come out in 2 weekends and we need to go over some of our investments that we have together, because we actually have investments together now. And I want to go over some taxes and stuff like that. He said, yeah, sure. And I said, okay, great. Bring your golf clubs. And I'm going to call Joey and invite him. So Joey's in the red baseball hat. I'm in the white baseball hat. So I called Joey and he was living in Florida at the time. I said, Joey, Scott's coming in a couple of weekends and we want to go over some of the investments that we have with you. And we're going to go over our taxes also. Is there any way you can make it? He said, yeah, I can make it. I said, great, bring your golf clubs. All right. He said, okay. So they were going to stay at the Marriott Hotel in downtown Seattle. Well, number one, that's a 40-minute drive for me. Number two, I hate driving in downtown Seattle because it's all one-way roads. You can see where you want to go, but you just can't get there because they're all one-way roads going the other direction, it seems like. And the Marriott, it was about $350 a night for them to stay there. So I said, you guys don't do that. Don't stay at the Marriott. You can stay at my house. Okay. I got a couple extra bedrooms and more than welcome to stay at my house. And besides, I only charge $200 a night. So they were there Friday night, Saturday night, and Sunday night. So I collected $200 from Scott for Friday, Saturday, and Sunday. That's $600. And I collected $600 from Joey. I collected $1,200 for renting my house out. Do I have to declare that as income? That is 100% tax-free, $1,200 tax-free money to me. Now, this is where it gets interesting, okay? By the way, entertainment is not tax deductible. You cannot deduct entertainment anymore. As of 2017, that was taken off the table. You are not allowed to deduct entertainment. Golf is considered entertainment. Golf is not tax deductible, or is it? Because when we went golfing, folks, who do you think paid the green fees? I did. But what money did I use to pay their green fees? I used the $1,200 that they gave me. I used part of that to pay for their green fees. Did they get a 100% tax write-off on money that they paid me? Yes. And I even gave them a receipt. It was lodging for a business meeting. Lodging for a business meeting is 100% deductible. So the $600 that Scott gave me, he got a $600 tax deduction. The $600 that Joey gave me, he got a $600 tax deduction. Guess what? I used part of that money, okay, to pay for the green fees. So in essence, Scott and Joey both got a 100% tax deduction for golfing. They gave me the money. I then paid for their green fees, and they got a 100% tax write-off out of it. So you take this tax deduction and this tax deduction, put them together, and poof, come up with a new tax write-off. How about this one? Weekends and holidays. This is hilarious because Congress wrote this. The people we elected to Congress, this is what they wrote. If either a weekend or a holiday falls between 2 business days, you guys, that happens every week, okay? Let me repeat that. If either a weekend or a holiday falls between 2 business days, that happens every single time. The weekend or holiday is considered to be a business day and is tax deductible. When was the last time you heard that one? Okay, these are all laws that Congress passed that they don't tell anybody about. So if either a weekend or holiday falls between 2 business days, the weekend or holiday is considered to be a business day and is tax deductible. So what I did is I called Scott on the phone, said, hey Scott, I want to fly out and I want to meet with you about my taxes. He said, why do you want to do that? We can just talk over the phone or whatever. I said, no, I want to meet with you in person. I want to go over everything and make sure I'm doing everything 100% right. And he said, okay, when do you want to fly out? I said, Alaska Airlines has a flight to Denver from Seattle, and I land at about 4 o'clock on Friday. He said, Pat, that doesn't work. He said, we close at 4:30. I said, I know, I'll just stay over the weekend and we can reconvene on Monday. He said, you've been reading my manual, haven't you? I said, yep. So anyway, what happened was I flew out to Colorado and I met with Scott, and he picked me up from the airport on Friday afternoon. We drove for about 2 hours and 15 minutes up to a little place called Dillon, which is right at the base of Keystone and Breckenridge. Okay. Scott just happens to have a condominium in Dillon. And so my wife, Carrie, and I, we flew out there and we stayed in his condominium with him for the weekend, Friday night, Saturday night, and Sunday night. Do you know that he charged me $200 a night to stay in his condominium with him? Where do you think I got that one from, right? And that's fine. So I paid him $600. Skiing is not tax deductible, folks. Well, guess what? I paid him the $600, right? He paid for our lift tickets. I just got a 100% tax deduction for skiing. My wife and I both did. And for the hot toddies that we had and the meals that we ate and all that stuff, it was all 100% deductible. Monday morning came, we reconvened our meeting and our business meeting, and the whole entire weekend was tax deductible to us. Where is it reasonable to have a business meeting? There's about 30 countries where it's considered reasonable to have a seminar or convention or business meeting. There's about 30 countries. So here they are. There's Baker Island. We could go to Baker Island and have a seminar. How do you like that? There's Bermuda, there's Canada, there's Costa Rica, there's Guam, okay? There's Honduras. We've actually had business meetings in Honduras before, by the way. There's Jamaica, there's Mexico. My wife, Carrie, and I, we actually have rental properties in Mexico. So we have to go to Mexico 4 or 5 times a year to check on the rental properties, and it's 100% tax deductible to us. There's Puerto Rico, there's USA, there's the US Virgin Islands. Where do you think St. Thomas is? St. Thomas is in the US Virgin Islands, folks. Well, we've had business meetings at St. Thomas. We've actually had board of directors meetings there. And so we have to get to St. Thomas. How do you get to St. Thomas? Well, you can either fly or take a boat. We decided to take a boat. Here's what it says about cruises in the tax code. It says cruises are not tax deductible unless, okay, it is a US registered ship, which most of them are not. I know there's a paddleboard on the Mississippi River that is, but all the big cruise ships, I don't know of any of them that are registered in the United States. They're all registered like in Panama or something like that. So that knocks them all out. Number 2 is all ports of call have to be within the United States, which pretty much doesn't happen unless it's the paddle ship on the Mississippi River. And number 3, you have to show how many hours per day you spent in business meetings while you're on the ship. And you have to get written documentation for whoever put on the business meeting that was on the ship. You have to get written documentation from them that there actually was a business meeting aboard the cruise line. So pretty much cruises are not tax deductible. It's not happening. They make it impossible. All right. Well, 72,000 pages of tax code, keep turning the pages, 30,000 pages later, here's what it says. And this is in Scott's manual. It says, if you travel by ocean liner, cruise ship, or other form of luxury water transportation for business purposes, there's a daily limit on the amount you can deduct. The highest federal daily limit for luxury water travel is $940 a day. Now, what you have to do is you have to show that you used the cruise ship or ocean liner or luxury water transportation as a form of transportation to and from a business meeting. That's all. And that's easy to do, okay? It's your job to document that. It's your job to document it the right way and do it the right way and give your tax preparer the correct information. Because if you don't give your tax preparer the correct information, you just lost $940 a day. And guess what? That is a slow boat. 3.5 days to get us there and 3.5 days to get us home. So $940 a day on that one. How do your taxes go from $62,000 down to $3,500 like mine did? It's all these little things. There's not one big tax deduction. It's a whole bunch of little things that add up. So here's the 2 words the IRS looks at. These are the 2 most important words, folks. What is your intent? We've already talked about that. And is what you're doing reasonable? Intent and reasonable. Those are the things you have to be looking at. Scott talks a lot about this in his videos that he has, and also in his manual, and he shows you what the right intent is. He shows you what's reasonable, and he shows you how to document it. Here's how I do my taxes. It takes me less than 20 minutes a year to do my taxes. So I get this questionnaire, and basically all it says is, it's called a tax organizer, but basically what it says is, how much money did you spend on meals, like going to Starbucks and things like that? For business purposes. You write that number down. You have all this already documented in your tax tracker. So you just total everything up in your tax tracker once a month and you put it in a summary book. So then when it comes time to do your taxes, you have a summary book that has 12 pages in it, January, February, March, April, May. So in this summary book that you have, so when it comes time to do this, I just pull out my summary book. There's 12 pages. It says, how much money did you spend for meals? I total up 12 numbers and I write that number down. And then it says, how many business miles did you drive? I total up 12 numbers. I write that number down. How much money did you pay your kids for working for you? How much money did you spend for advertising and promotion? How much money did you spend on this? How much did you spend on that? And so this tax organizer just goes through and asks you all the questions. They do not want your shoebox full of receipts. That the only people that will ever want your shoebox full of receipts is the IRS auditors. So when you get your audit notice, you're going to have to prove the expenses. So you're going to have to show them your shoebox full of receipts. And then you're going to have to also show them where the money came from to pay that. So you're going to have to show credit card statements and say, yeah, that $10 at Starbucks, I put it on my Visa card. Here's the Visa card. Here's the receipt. So you have to show proof of payment, and you also have to show the receipt, where the money came from and the receipt. Otherwise, people could go to Starbucks and just grab a whole bunch of receipts out of the garbage can and say they spent the money. Doesn't work that way. So you're going to have to show where you wrote a check for it, or where you put it on a credit card, or if you paid cash, you're going to have to show where you withdrew that money out of your checking account. That's what happens. Takes me about 20 minutes. I then take this, and what I used to do is I would take this and I would just fax it over, back over, or scan it and email it back over to Scott, and they would do my taxes. The problem is Scott retired. So Scott's not doing this anymore. Scott, the only thing that he's doing is he's updating the videos and the manuals and all that to teach people how to capture all these tax deductions. That's the only thing he's doing now. He sold his law firm and he's pretty much retired, but he really enjoys, updating all of his information to help people save money on taxes. So that's what he's doing. Let's talk about audits real quick. By the way, who do I use for my taxes right now? I have started using Kevin O'Leary's tax firm. And so their tax firm, and you're anybody who gets Scott's program, you're going to get their contact information and all that. You can use them if you want to. So, but that's who I'm using now. So it's not a question of if, it's only a question of when you're going to get audited. Whoever's in the White House, they have this figured out a little bit. They're not going to go out there and raise taxes on everybody, because if they do, they're not going to get reelected. Right? Common sense. The problem is, we here in the United States, we are so upside down financially. We are to the tune of something like $32 billion or trillion dollars in debt. Let me put that in perspective. 1 million seconds is 12 days. Holding a 12-day-old little infant in your arms, that's 12 days. 1 million seconds, 12 days. 1 billion seconds is 32 years. That's the difference between 1 million and 1 billion. 1 trillion seconds is 32,000 years. So 1 million seconds is 12 days. 1 trillion seconds is 32,000 years. We are $32 trillion in debt as a country. You can't even comprehend how much money that is. So here's what they did. And this started probably almost 15 years ago. So it's been with both parties. It doesn't matter who's in the White House. It doesn't matter any of that kind of stuff. What they're doing, what Congress is doing, is they are giving the IRS literally billions with a B, billions of dollars, saying, we want you to go out there and audit as many people as you possibly can. We do not want to raise taxes, but we have to generate all this revenue because we're so upside down financially. So the IRS, we're going to make you the bad guy, and you're going to go out there, and we want you to audit as many people as possible. And we're going to give you billions of dollars to do this. So it's not a question of if you're going to get audited, folks. It's a question of when. And you need to become audit proof. So check this out. More Americans than ever will be subject to unwanted attention from the IRS this season as the government pumps billions of dollars into tax collection to help pay down the deficit. That's CNN money. Bloomberg, IRS audit rates almost double for US taxpayers. MSNBC, deficits could cause more IRS audits, experts say. Okay, CBS News, we saw individual audits increase, reaching the highest rate in the past decade. So here's how you become audit proof. I'm going to show you a page in my tax tracker. So this is set up exactly the same way as the IRS auditors, the revenue agents. This is how they have to track everything. So June 16th, home office to the PO box RT. RT stands for round trip. Okay. It was 2 miles, 1 mile there, 1 mile back. Why home office? Because your business miles start at your first place of business. So if I would have just said home to PO box, guess what? There's no deduction. But because I went from my home office, I went from place of business to my PO box, which is a business PO box. Guess what? Now it's all deductible. Then I went from home office to Starbucks. I met Ralph Nadeo. He takes care of all of our medical insurance. Well, our medical insurance is paid for by my company. My company pays our medical insurance. Home office to Nordstrom's round trip. Gift certificate is a bonus. I bought a gift certificate for $200 and gave it to one of our tenants. They did a bunch of repairs on one of our houses. They've been tenants for a long time. And so I bought them a $200 gift certificate as a thank you. Totally tax deductible. The miles are tax deductible. The $200 is tax deductible. And I have it documented exactly how the IRS wants it. Home office to Toby's office. Toby's our attorney. He has an office in Seattle. Carrie is my wife. So Carrie and I went to Toby's office to talk about some real estate contracts. It was 28 miles one way. After we went to his office, Carrie, my wife, and I went to dinner. Is dinner tax deductible? Yes or no? Yes. Why? Because Carrie was at the business meeting at Toby's office with me. Then we went and had dinner. We had meals within 24 hours of that business meeting, $79.45. Guess what? That was 100% deductible because right now, meals are 100% deductible. They're not subject to the 50% limit anymore. Okay. So they're going to change that back to 50%. We just don't know when. So then we went back to the home office. It was 32 miles to get back. The next day I met Darren Murphy. He does some web design for me on some of our rental properties and stuff. I met Darren Murphy at Starbucks. It was another $10. Then I got home. I went to the P.O. box. I go to the P.O. box every business day to see what business mail I got. There was a check in the mail. So I come back to my home office, make a photocopy of the check, go back to the bank, deposit the money. That's that. That's how I track it. And that's how it works. Okay. That's the tax tracker. There's also a summary book. So at the end of every month, I just total everything up. When my kids were at home, I used to have my kids do this and I'd pay my kids for doing it and got a tax write-off for paying the kids. But they're all grown now, so I'm missing out on that one. But there's a summary book with 12 pages, just January through December. And so you total everything up, you put it on the summary page. At the end of the year, when it comes time to do your taxes, you have your summary book that has everything in there, all your numbers, all your expenses, all your mileage, all your everything. And if you ever get audited, or I should say, when you get audited, guess what? You have now become audit proof. You have everything documented exactly the right way, the way the IRS likes it. This is all about having a system. That's the name of the game, is a system, okay? I owed the IRS $84,123.55. This was an audit notice that one of Scott's clients got, okay? How would you like to get an audit notice saying you owe $84,000? Thanks to Scott, after the changes, I owed nothing and received a check for $117. Watch this. Obviously, the name has been blacked out because of attorney-client privilege and stuff. Account balance before this change, $84,000 due. Decrease in taxes because of this change, credit. Filing late penalty, reduced. Estimated tax penalty charge was reduced. So credit. Amount to be refunded to you, $117. Scott is the best of the best, folks. There's no doubt about it. Scott saved me over $100,000. I recently received an audit notice and the IRS was going to come to my house. I called Scott and the next day I received a phone call from the IRS saying they were sorry and they're not coming over. Scott is absolutely the best. We won the audit. That's Robert Shemin, okay? And they won the audit. So here's the last thing. How much money do you have coming back? How would you like $17,000 within the next 30 to 60 days? That's what I did. Here's how. So remember in the very beginning, I showed you 1998 and when I had Joe Doria do my taxes and I paid in $20,000 and I got a $5,000 refund. So I'm into the IRS about $15,000 on this. Well, 2.5 years later, I'm on this phone call. Scott's doing this training that he used to do. And he's talking about how you can go back over the last 3 years of tax returns that you filed and reclaim any tax deductions. Well, this was 2.5 years after I got his program. So I thought, I remember Joe Doria did my taxes and I paid all that money. Let me go back and look at that tax return and see what I missed. And so I got out the tax return and started looking at it. And I don't know how to fill out forms. I'm not a tax preparer. I'm not a tax attorney. I'm none of that. I'm a client of Scott's. I just know I've gotten really good at documenting expenses and categorizing expenses. That's what I'm good at. So I didn't know how to read all these tax forms and all this kind of stuff. So what I did is I used to always balance my checkbook in a little program called Quicken. Not QuickBooks, but Quicken. It's just a computer program where you can download all your bank statements and all that kind of stuff, and you can just balance your checkbook. That's all it is. Very simple. So I went back into 1998. This was 2.5 years later. I went back into 1998 and I went through my Quicken and I recategorized all my expenses. And then I was able to print out a report. And it was crazy what I found out. Absolutely crazy. So what I found out is that I actually overpaid my taxes by $13,730. That's how much I overpaid, right? So Scott said, fill out a form. It's called a 1040X. And so I got out this form, a 1040X, filled out this 1040X. And you can download these online, by the way. You can download a 1040X online. It's no big deal. I'm going to get $13,700. It says, how much do you want refunded to you? All of it, $13,730. I then got a check back from the IRS folks. Check this out. They paid me almost $4,000 of interest on that. So in 1998, I paid in about $15,000. I got back $17,000 because they paid me $4,000 of interest. Is this a great country or what? Every single one of you on this call qualified for that. You just need to know how to do it, right? So you need to know what the tax deductions are. You need to know how to implement them into your life, and you need to know how to document them. That's what you need to know. You know, you don't need to know how to fill out the forms. You don't need to do your own taxes. In fact, they recommend you don't do your own taxes for liability reasons, but you don't need to know any of that. You just need to know what the tax deductions are, how to implement them the right way, and then how to document everything so you become audit proof. That's your job. So here's Sandra. Sandra said, I purchased Scott's tax package and followed through with the 3-year review. I'm ecstatic because I just received a check back for over $11,000 that my CPA had me overpay. Who would have thought that the IRS would refund my money with interest that I overpaid because my CPA didn't take all my deductions? All right. And she actually did an audio recording of this. And so I'm going to see if we can do this and you can hear it. I'm going to turn the volume up here.
Hi, Patrick. This is Sandra Dufoli. Jeannie Orlowski gave me your phone number and told me to give you a call. I bought your tax system back in August in New Hampshire, and I worked with your group for the last month or so, and I got back $11,000+ in mass and federal and state returns. So if you need a testimonial, I would be happy to do that, and I am freaking psyched.
But that was Sandra, you know, so every one of you on this call qualify to do that. You just need to take advantage of it. So in summary, here it is. It's all about knowing the rules and giving your tax preparer the correct information. That's your job. CPAs and tax preparers cannot change the information you give them. They simply input the information you give them. It is a felony. It is against the law. They go to jail if they take the information that you provided them and change it. They can't do that. I've had people tell me before, well, I have a really, really good CPA, and you know, they just take care of all of it for me. It doesn't work that way, because your tax preparer or your CPA, they don't know what your intent was. They weren't there. They don't know. You have to give them the information. That's like saying, I don't have to do anything because my dentist comes over and brushes and flosses my teeth for me every day. That doesn't happen, folks. Okay. It's your job. You have to take control of this. It's your job to give them the right information. That's how you save money on taxes. You don't have to, but if you want to save money on taxes, this is what you got to do. Categorizing your daily expenses is way more important than who your tax preparer is, as long as they're qualified. Okay. Your tax preparer has to be qualified. Tax preparation is 1 day, April 15th. Tax planning is 365 days a year. The better you are at categorizing, the lower your taxes are going to be. That is the name of the game. There are hundreds more tax deductions. And, you know, if we have 2 days together, I could probably go over a lot more with you, but we don't have that much time. So our accountant prepared our taxes and told us we owed more money to the IRS. This is Greg and Eva. Eva works for a doctor's office. Greg works for a construction company. Okay. And they are W-2 wage earners. They don't own a business or anything else. They're W-2 wage earners. Patrick set us up with Scott, and after we recategorized our expenses the right way, we ended up receiving over $8,000 in a refund. We are so thankful for Patrick and Scott. So I was talking with Eva one day, and she said, Pat, we owe $6,000 in taxes. I can't believe we owe $6,000. I said, what do you mean you owe $6,000 in taxes? Don't you have money taken out of your paycheck every time before you get a paycheck? She said, yeah, but our CPA said we owe $6,000 in addition to what we already paid in. They paid $3,995. They got Scott's tax kit. Eva was diligent, and she went through the tax kit, and she went through all of her expenses, and she categorized everything for the year. And bottom line is, they didn't owe $6,000. They actually got a refund of $8,000, right? So that was Greg and Eva. Here's my wife, Carrie, and myself. In 1999, we paid $3,995 to learn these strategies. That's what I paid Scott. We then invested our tax savings into the stock market and real estate. So what I did, folks, is every year, the amount of money that I saved on taxes, I didn't go buy a new Tesla and go to Hawaii and all that kind of stuff. We took that money and reinvested mostly into real estate. And we've been doing this since 1999. So what's that? 23 years now. Okay. Guess what? It is amazing, amazing what happens over 23 years in real estate when you start investing just a little bit each year. The money that we would have paid the IRS, we now started reinvesting in the stock market. If I would have never met Scott, I would have never done this. I would have never known how. Okay. I would still be paying the IRS the maximum amount and overpaying my taxes. So in 2017, we made a little over $3 million, and it's even better now. So in 2017, we made a little over $3 million because of all these different investments and everything that we have. And it's all about a system. So did I pay tax on that $3 million? Yeah, I did. And it was a lot, but that's okay. This is not about not paying taxes. It's about paying what you legally owe. So we also have a Wyoming corporation. It's called Kana Inc., K-A-N-A. It actually, well, I'll tell you, Kana stands for kick-ass, no attitude. My wife came up with that name. And so we named one of our entities Kana. So it's a Wyoming corporation. And on here, it shows a little over $3 million of income for 2017. Taxes due, $295,000. Yep. So we paid about $300,000 on $3 million worth of income. I was happy to pay that. No question about it. That's how much money we legally owed in taxes off of $3 million of income. I would do that every day of the week if I could. If I could make $3 million and pay $300,000 in taxes, sign me up. That's a good deal, right? And the reason it was only $300,000 is because we did a lot of tax planning and we were able to capture a lot of tax deductions. That was how. So Scott's tax deduction workbook is all completely brand new for 2022. There's over 300 pages of tax saving strategies. Go to mytaxkit.com. We've already had about 9 or 10 people order this. And for the first 20 people, you're getting a 50% discount. So the manual tells you what the strategies are. The videos teach you how to implement the strategies into your life. So you get a USB stick, you get the DVDs, you're going to get the online videos that are updated. Every time there's major tax changes, Scott goes in and updates all of these videos. So you're never going to be out of date. You don't have to ever pay any more money or anything. You just get all the updates for forever for free. So this is what you get. Free shipping, and there's a 100% 30-day money-back guarantee. Get it, check it out, kick the tires, go through it, read it. Watch the videos. If it's not for you, guess what? 100% money back guarantee. All you got to do, you send it back and they'll go ahead and refund your credit card 100%. So whatever credit card you put it on, it just goes right back on your credit card. So before you even get the bill, you're going to get the tax tracker. That's a free bonus that you're going to get is the tax tracker to help you document everything and become audit proof in the process. There's also a monthly tax newsletter that comes out with all kinds of little tips and tricks and different things that are going on. Anytime there's any changes or new things or different things you can do to save money on your taxes, it's all listed in here. There's the $10,000 guarantee. They'll find you $10,000 in missing or potential tax deductions, or they'll pay you $100 just for your time. This is from Mr. Wonderful on Shark Tank, Kevin O'Leary. So that's pretty cool. Here's how you lower what you pay in taxes. Know what the tax deductions are, know how to implement them, and know how to document them. So that's what the whole entire program is all about. So go to mytaxkit.com. You can order these, and it's for the first 20 people, you're going to get a 50% discount. I have my phone sitting right here with me, and on my phone, I have an alert set, and it shows me how many people have already purchased. So if I look at this, how many people have already purchased? 12. So there's 8 left. So if you're thinking about doing this, do it. 30-day, 100% money back guarantee. And that's what Scott's program is. That's what I did. And that's how my taxes went from $62,000 down to $3,500 just that first year. And like I said, we've taken all of our tax savings over the years. We've reinvested it. And it's amazing. The only difference between me and anybody else out there, really and truly, is I bought this and I got started, 20 years ago. And I just took all the money and reinvested it, and it grows, folks. I mean, it's amazing how it grows. So anyway, Shauna or Steven, or are you guys still there? What I'm going to do is I'm going to stay on the line. You guys are there? Awesome. So what I'd like to do, if it's okay, is I'd like to stay on the line and go ahead and go into the chat thing and answer questions that people might have. Is that okay?
Absolutely. Colleen first said, do we become more of an IRS target if we submit these types of returns where we pay far less? I'm one who has always paid and paid every year.
That is a great question. And here's what happens with the IRS, folks. Think about this. Think about the state patrol out there on the interstate, and they have the radar gun, and they're pointing the radar gun at you as you're driving down the road. Okay. If you're going the speed limit, if you're following the law, are you going to get in trouble? No, not at all. If you're breaking the law, you're going to get in trouble. And the IRS, believe it or not, the IRS, they really and truly, they just want you to pay what you legally owe. They're not out there to get you to try to make you pay more than what you legally owe. They're not. So take every single tax deduction that you morally, legally, and ethically qualify for. The trick is you have to document it. That's what keeps you going the speed limit in this, is the documentation. So the IRS, that's the only way that they can judge it, is by how you document it. So if you're not documenting it the right way, then yeah, you could get in trouble. If you're documenting it and doing it the right way, then you're totally safe, and there's no problem at all. You'll go into it, if and when you get audited, you're going to show them your tax tracker, and you're going to show them how you documented everything the way Scott taught you how to do it. And they're going to look at that, and they're going to say, that is awesome. You're perfect. You're good to go.
Catherine Sisson said, do you recommend a bookkeeping company?
That is the toughest part of this whole entire thing, because the way you track everything is 10 times more important than who your tax preparer is. Here's how I do it. Okay. I have a bookkeeping company that I use that we have an agreement. Okay. And I've used these guys for many, many years. And so they kind of have an idea of how it works now, but still I do this every single month. What they do is all of my bank accounts and credit cards, all that stuff, they use a computer program called QuickBooks. I don't like QuickBooks. I don't use QuickBooks. I don't get involved in any of that stuff. They download everything into QuickBooks. Once a month, they email me an Excel spreadsheet, okay, of all the expenses and how QuickBooks categorized it all. And what I do once a month, and it doesn't take me very long to do this, it takes me maybe half hour, 45 minutes once a month. I go through that Excel spreadsheet because I know how to work with Excel. I go through that Excel spreadsheet and I look at all my expenses. And if I need to recategorize something, I highlight it and recategorize it. And in the beginning, when I started doing this, it took longer because I had to recategorize a lot of stuff because they didn't get it. Now, because they understand it more, I still have to recategorize some things, but a lot of it they get right. And so, but there's a lot of it that they don't get right also. And I have to go in and recategorize because they don't know what my intent was. So then I go through and I highlight everything on this Excel spreadsheet and I send it back to them and they go back into their QuickBooks and they fix it all and done. So that's how I do my bookkeeping.
And then Justin says, can someone that doesn't have a business benefit from Scott's plan?
Yes. Now here's the question of the day. What is a business? Okay. Some people think, well, a business is you have to have an entity set up. An entity and like an LLC or a corporation or something like that, that is not a business, folks. That is what's called an entity. You could have an entity and not have a business. A business is activity. That's all the IRS cares about is activity. They don't care really if you do it in a entity or if you do it personally. If you do it personally, you're a sole proprietor. If you do it in an entity, then you have a business, corporation or LLC set up. Okay, but a business is activity, and according to the IRS, if you do anything in your life basically with the intent to make a profit, other than a W-2 job, okay, working for the man. That's not considered an intent to make a profit, although it is, but it's not, the IRS says it's not an intent to make a profit. And if you have stock market investments or real estate investments and you're not a real estate professional, those are not considered a business. There are ways to make stock market trades a business, and there are ways to make real estate transactions and your rental properties a business also, but you have to set it up the right way. And Scott talks about all that in his manual. But get back to your question. Can someone that does not have a business benefit from Scott's plan? Well, Greg and Eva, that testimonial that I showed you, she worked for a doctor's office. He works for a construction company. They didn't have an entity set up. They didn't have a business. They didn't have anything. Their CPA said they owed $6,000. They went in and recategorized everything, and they actually got an $8,000 refund. When I talked with Eva about this, I said, how did you guys do that? That's pretty good, considering you don't have business or anything else. They did have a rental property. They had one rental property. And it wasn't necessarily considered a business. It was an investment, but there were some tax deductions associated with that. And that's how they did that. So does this work if you don't own a business? Yeah, absolutely. It works way better if you have the intent to make a profit. That opens a floodgate of tax deductions. But you have to know what a business is. It doesn't mean an entity. It doesn't mean any of that. A business is activity, and an activity is the intent to make a profit.
I have an associate's degree in accounting technology. Would I be qualified to file taxes for myself and or others, or would it still be advisable for me to have someone else file my taxes?
Here's what Scott told me a long time ago. He said, Pat, if you ever talk to anybody, always encourage them to use somebody else to file their tax return. Here's why. When Scott worked for the IRS, he saw people actually go to jail because of mistakes on their tax return. If you file your own tax return and you make a mistake, it's 100% up to the IRS to say, oh, that was an innocent mistake, we'll forgive that. But if the IRS says, we think you did that on purpose, guess what? That is now a felony. It's called tax fraud. And if you do your own tax returns and you make a mistake on it, the IRS could, I'm not saying they will, okay, they could come back to you and said, we think you did that on purpose. And if they do that, that is now a felony. So Scott said, never, ever, ever, ever do your own taxes. You always want to hire a tax professional to do it for you. And, you know, there's all kinds of people out there that prepare tax returns. There's actually, this is an interesting statistic. This came out about a year ago. There are more tax preparers in the United States than there are first responders, police officers, state patrol, firefighters, all combined. There's more tax preparers.
Yeah,
So,
I was watching the Bills game the other day and I looked up how many people were at the stadium and it was like 86,000 people. And that's like how many people they just hired for that position this year.
Right. So crazy. So anyway, are you able to help with taxes that were filed inaccurately by my prior accountant? Absolutely 100%. Remember, here's what the rule says. Any tax returns that you have filed within the last 36 months, which is 3 years. So the tax return that you filed 3 years ago was for 4 years ago, because you have to wait till the end of the year to file your tax return. So you can go back over the last 4 years of your life, and any deductions that were missed or that were wrong or anything that happened, you can go back and fix that and send in that 1040X. And the IRS, they actually like it when you do that, because it shows that you're trying to do things the right way. And that's all they want. They just want you to file an accurate tax return. They don't necessarily want you to overpay. Okay, that doesn't make any difference to them. And they don't want you to underpay. They just want it to be accurate. They want you to go the speed limit. So of course you can go back and change that. And if you have a tax preparer who didn't take all the tax deductions you're legally entitled to, you hired them, fire them. Find somebody that is willing to take all the tax deductions you're legally entitled to. One of the things that we found out, Shauna, is there's a lot of tax preparers out there that way overpay taxes for their clients, because they don't want their clients to get audited, because maybe their clients didn't document things the right way, or maybe the tax preparer doesn't want to get involved in an audit, so they have you overpay just because it makes their life easier. That happens also. You need to find an accountant that's going to do it the right way for you.
Okay. Duck wants to know, do you still need to show receipts even with the tracker? And I'm not sure which tracker. Okay.
The tax tracker. Yeah. Okay. So the tax tracker is what you get with Scott's program, where you document all your expenses and everything. And absolutely, there's 3 things that the IRS is going to want to know. Okay. They're going to want to see a copy of the receipt. They're also going to want to see a copy of where did that money come from to pay for that. Because it's not just about the receipt. If it was just about the receipt, like I said earlier, you could go to the end of the line at Starbucks where the garbage can is, and it's full of receipts. It's not about just grabbing a handful of receipts and then saying, hey, I got all these receipts, I'm going to say these are all tax write-offs. The IRS is way smarter than that. Okay. So you have to have the receipt. Then you have to prove where the money came from to pay for that receipt, whether it's on a credit card statement or whether it's on a check, or if you paid by cash, you're going to have to show how and when you made the withdrawal out of your checking account to pay for that. I never pay for anything with cash because there's no record of it. Everything I do, I put on credit cards because I get miles for it anyway. I get free travel. So I put everything on credit cards just because that shows a record of it.
Lisa put something in the chat rather than the Q&A, but she said her van is 5 pounds short of 6,000 pounds. Yep. Is there any way around that? Like, does it have, like, if it weighs 5,995,000 miles?
Right. So here's what happened. Volkswagen Touareg weighed 5,997 pounds. It missed the mark by 3 pounds. Volkswagen was smart. What they did is they added 10 pounds of dead weight to the chassis. They just added 10 pounds of weight to get it over 6,000 pounds. Because now, if somebody's looking at buying a Volkswagen Touareg rather than an Acura MDX is the competition to the Volkswagen Touareg. The Acura weighs under 6,000 pounds. The Volkswagen Touareg is over 6,000 pounds now. Guess what? They use that as a marketing ploy. Because if you go into a Volkswagen dealership and you're looking at another car, the salespeople can tell you, hey, listen, if you're using this for business because it weighs over 6,000 pounds, you're going to be entitled to this much of a tax deduction, which is going to put another $8,000 in your pocket. If you go buy the Acura, you're not going to get that, and it's going to cost you an extra $8,000 on your taxes. So it has to be over 6,000 pounds. And so
there's no way around it.
Nope, there's no way around it. It's all about what the manufacturer specs are.
Okay. And then there's really
trade it in and go get another one.
Yeah, true.
As long as she does it by the end of the year. You have until the end of the year to do it.
Yeah, and she did say, can you add a trailer hitch for more weight? But I think it probably has to be part of the vehicle.
It has to be the manufacturer's weight, the GVWR that's posted on the car.
And then William said, can I watch this again later? Yes, it'll be on the YouTube channel. And then Jason's wondering, he was the same one who asked about going back in taxes or back years and how to get a hold of you directly, if anything.
Okay, here's what happens. Okay. I have an agreement with Chris because you guys are all students of, Chris's, and I totally respect that. He asked me if I could come and share this information with you and whatnot. We did a live event a month or so ago there in Buffalo. By the way, love Buffalo. We just had the time of our life. It was so awesome. And the best chicken wings ever, right? And so I had an agreement with Chris that I'm not going to give out my personal contact information to the people on this webinar. And I'm going to respect that. However, anybody who orders Scott's package, you're going to get the phone number and you're going to get an email address on how to contact us. And so if you want to talk to me directly, if you have Scott's program, all you got to do is call the phone number and say, could you have Pat give me a call? Or send an email and say, could you have Pat respond to this? And then I'll email you from my personal email. I can do that, but I can only do it with the people who actually get Scott's program, because then you're going to get the email and phone number. But I promised Chris I wouldn't give my contact information out to everybody on this call, because you guys are all students and clients and working with Chris, and I totally respect that.
Okay, perfect. And then that is it as far as questions. Thank you so much for your time today.
Shauna, I was going to tell you also, we are up to 18 orders right now. And so there's 2 left. So if anybody's thinking about this or wants to do it and get that 50% discount, as soon as 20 people order on the website, it automatically goes up to the $3,995. So if you go to the website, and it's still at the $1,997, you'll see a thing up on top that says you are one of the first 20. But as soon as that's used up, that disappears and it goes to the regular price. So there's 2 left right now.
Okay, perfect. Thank you so very much.
Yeah, all right. Well, everybody, you guys have a great rest of the week and everything, and we're going to go boating. So we'll talk to you a little bit later.
Enjoy. Bye everyone.
So I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button, actually smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.